Picture this. You finally find an investment everyone agrees is a sure thing. Your group chat won't shut up about it. Prices keep going up. You don't want to miss out, so you stretch a little. Maybe put in money you probably shouldn't. And then you wake up the next morning and it's gone. By sunrise, the richest people in Holland were bankrupt. Here's the thing. If you've ever chased a hot stock, a crypto pump, or even a can't-miss side hustle, this story is uncomfortably familiar. Introduction. My name is Zach, and I spend way too much time thinking about how one trade crashed the world's first stock market. Story. The Dutch Tulip Mania, 1637. Angle. One night, generational wealth wiped out. By sunrise, the richest people in Holland were bankrupt. If you're someone who feels like you're always late to the best opportunities or constantly worried you're making the wrong money move, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now look, most people think the first stock market crash involved banks or oil or tech. It didn't. It involved flowers. The story. In the 1630s, the Netherlands was the richest country on earth. Trade was booming, money was flowing, and tulips, yes, literal tulips, became status symbols. Rare bulbs started selling for insane prices. Some varieties reportedly traded for more than 10 times the average annual income. One bulb could cost as much as a luxury canal house in Amsterdam. Here's what most people don't realize. Most traders never even saw the tulips. They were buying contracts, basically early futures, promising to buy bulbs later at higher prices. Sound familiar? The math. Let's make this real. If the average skilled worker earned roughly the modern equivalent of $40,000 a year, some tulip contracts were selling for $400,000. And people used leverage, borrowed money, promises of future income. So what could possibly go wrong? The crash. In February 1637, one routine auction failed. Just one. No buyer showed up. Panic spread overnight. Everyone tried to sell. Nobody wanted to buy. Prices collapsed by over 90% in days. Contracts became worthless. Fortunes that took generations to build evaporated before breakfast. This is where it gets really interesting. Psychology. The problem wasn't tulips. It was human behavior. Fear of missing out. Social proof. The belief that this time is different. People weren't investing. They were outsourcing their thinking to the crowd. Now, you might be thinking, we're smarter today. We're not. We're just faster. Modern parallel, plus insight. Every bubble follows the same script. Rising prices convince people risk no longer exists. Math gets ignored. Psychology takes over. Here's the simple rule they forgot. Price and value are not the same thing. Actionable takeaways. So what can you do right now to avoid repeating this mistake? Never invest in something you can't explain in one sentence. If returns depend on finding a buyer tomorrow, it's speculation, not investing. Set rules before emotions show up. Decide your limits in advance. Zoom out. If something has doubled with no change in fundamentals, ask why. Close. Plus motivation. Look, I get frustrated because these mistakes keep repeating, but the upside is you don't have to learn them the hard way. History already paid the tuition. If you want to build wealth without falling for the same traps that wiped out fortunes overnight, subscribe to the channel, because the goal isn't to get rich fast. It's to stay rich once you get there.